Apparently, it is being rumored that Israel's retaliatory strike on Iran could happen as soon as tonight. This can have financial repercussions for our markets in the US. The bigger question will be, what impact does this have on energy markets? There was some encouraging yet mixed news today that Israel would not be targeting Iran's nuclear or oil facilities, but that could change, and there's really no consensus on that. Here in this video, I will go over what happened today in markets, what could be coming next, what we need to be on the lookout for, and Tesla stock. Because not just this Middle East situation, throughout the rest of this week, there is going to be important data that will move our markets. And maybe I'm just, sitting here with a tinfoil hat or whatnot, but I take notice of days where the S&P sells off like this after hitting new all-time highs. Literally just the day before. And I do have a couple of concerns for investors that you should probably be made aware of. Isn't it just ironic? 8 hours ago, CFRA's Sam Stovall says expect smooth sailing in the markets for the next 3 to 6 months. That could prove to be one of the worst short-term calls for markets. And it all depends on what happens over the next 2 weeks. But first up, news is being reported that a helicopter carrying the Israeli Prime Minister lands in a secure facility near Tel Aviv, where Netanyahu is expected to order the attack on Iran. Now, some people may be wondering, why is he basically sheltering in place when they order this attack? And the answer for that is quite simple. Iran has demonstrated they will send ballistic missiles to Israel. Now, there's only about a 12-minute time frame on those between launching them and actually hitting their target. So there wouldn't be much time to move around if you are Netanyahu and Iran wants to retaliate back, if they did that simultaneously. And it is being reported that Israel briefed the Biden administration on the general goals of the planned attack on Iran's regime, but not on these specific targets. Sources aware of the details tell local news the goals can change even in the 90th minute. And that's why I said at the onstart of this video, there's a lot of uncertainty here on what's actually going to happen. Here today, oil did sell off quite a bit. At one point was down more than 5% after rebounding a little bit into the end of the trading day once these headlines started to come out. And I do think oil is really the big black swan here, okay? Now, is this going to be a black swan event? Probably not. Statistically, I would argue no, because I think the last thing Israel wants to do is to piss off the US, right? That's the last thing that Israel needs right now, as they're essentially surrounded by enemies. And if you attack the oil infrastructure, cause a large spike in oil, put the US economy into a recession, you're not going to be very favored from the political landscape in America. So I do have concerns surrounding this, that even if Israel does not attack any oil infrastructure, perhaps you could still see oil prices go higher. But if Israel does attack some oil infrastructure, then you will see oil go a lot higher. And that's where this turns from a regional conflict that has very little financial impact on the US to a black swan event. If the price of oil rises, especially, rapidly, something large, then you will certainly get a recession in the United States. Again, not just because of the taxation, if you will, on every family that drives a vehicle in the US, the higher cost at the pumps, but that higher cost at the pumps changes the psychological behavior of people. They may skip out on this, or, not buy as much on that, or not go here because of the rise in gas prices. A rise in gas prices, economically speaking, is just as psychologically impactful as it is actually monetarily impactful via higher cost at the pump. People tend to not want to drive to this place or not want to do that because gas prices are high. And I really think that is the thing that we should be watching. heading into tomorrow if this attack does happen? And what do energy markets do? And how do they respond to this? Liz Young Thomas on X wrote today, the geopolitical risk premium in oil has evaporated, with WTI down from $78 to $70 per barrel in a week, mostly on news that Israel wouldn't strike Iran's oil facilities. Gold, however, as she points out, remains near all-time highs at $2,660 per ounce. But again, there's been a lot of mixed signaling in whether or not Israel does plan to attack Iran's nuclear or oil capabilities. Now, honestly, I can't believe I'm actually reading this right now, but Waymo's co-founder says Tesla has, quote, a huge advantage in data for robotaxi. He says Tesla could have 1 million times more data, which if you know anything about robotaxis and autonomous vehicles doing this at scale, it's really just a data game. The company with the most data will create the best product. That is the big reason why Apple dropped out of the race for autonomous software, autonomous driving in cars. At one point, Tim Cook said, autonomous driving is the holy grail of AI. He said this back in 2017 before AI was really on anyone's radar, and Apple was and has been trying to develop a autonomous vehicle for 10 years. At that point, they were 3 or 4 years into their development. They have since canceled that project because they just don't have the data that they need to get it up and running. And good luck trying to get Tesla to sell their data to Apple. Now, I do want to share a couple clips with you from CNBC. This one says the S&P 500 would be lower if this was truly an earnings-driven rally, says David Rosenberg. Now, I've shared a lot of David Rosenberg's commentary and thoughts here on this channel. He runs Rosenberg Research because he's one of the only bears of major financial institutions right now. One of the only ones. Everyone else is bullish. I don't care about the bull thesis here. I think we know the bull thesis. Bull thesis, soft landing, the Fed is able to cut, the economy holds up, and I'll even add in there my bull thesis, if we get the bull thesis outcome, is real estate sales start to pick up, start to see more volume there, driving more equity into people's bank accounts, and an upside surprise to consumer spending behaviors, okay? That is the bull thesis. The bear thesis is something that is a lot less talked about. Now, it's actually already happening. Believe it or not, earnings estimates have been falling for weeks now, and stocks have not reacted to this. And that's what David Rosenberg is going to really show you here in this clip.
Joining us this morning, Rosenberg Research President Dave Rosenberg. Dave, great to have you. We spent the last few minutes talking about some of this improving corporate sentiment, all-time highs. People are looking for some strong retail sales numbers this week. Are you able to poke some holes in any of those things? All of it.
Well, I would say this much, that, you know, if this was truly an earnings-driven rally in the stock market, the S&P 500 would be sitting at 4,600 right now, as opposed to 5,800 and change. So what's happened that I think is very interesting, and it just speaks to, you know, the animal spirits and the high degree of confidence that investors have. We've had a 4 multiple point expansion in the forward PE multiple just over the past 12 months. I mean, we're talking about a 2 standard deviation event. We've gone from 18 forward multiple a year ago to 22 right now. So that's really what the story is. It's earnings are still going up, but you know, we're tracking what maybe 5-6% year-over-year earnings growth for Q3. Stock market's up 34% over the past 12 months. So the price action in the stock market has outpaced the actual earnings momentum, call it by 8x, which when you look back at the data going back a century, that's a 1 in 10 event. That's what we're living in right now, a world that is extremely rare, but one where there is obviously tremendous exuberance, ebullience, and confidence, and that's what's driving the market higher.
If some of the activity comes in strong or continues to come in strong, do you think that hawks are deservedly worried about a repeat of inflation, or can you maintain your classic deflationary stance?
I'm not so sure it's going to reignite concerns over inflation because you can't just forecast inflation with one curve. You can't just do it through demand. You also have to have a view on what the supply side of the economy is doing. But the longer the economy stays strong, and I would question actually the veracity of a lot of the data that have been coming out. But if your view is that the economy is staying resilient or strong, in a 5% policy rate world, then what it has the Fed thinking is, where's neutral? And right now they think neutral collectively is 2 7/8. But what's going to happen is that the momentum is going to build that the neutral rate is probably quite a bit higher. Ergo, it's not so much about inflation, it's about that the Fed will not have to recalibrate to a lower neutral rate as is currently thought. That neutral rate would be higher. So I think that's the challenge that's going to happen via what we'll see in the Treasury market going forward. So it's really more the impact on the neutral rate than it is necessarily on where inflation is going to be going.
I do also want to share this clip with you in just a few moments from BNY Wealth's Alicia LaVine on her new 5,900 S&P 500 year-end price target. Again, I think a lot of this is just getting played out. I think it's more chasing than anything in this market. Because again, you're seeing earnings downgrades ahead of earnings season. So yeah, a lot of companies are going to beat on earnings, but they're beating at a much lower bar, something that we have not seen since really 2022. You've seen a little bit of this about midway through 2023 also, but you're getting the steepest downside revisions since about mid-2022, which is when reality set in that the Fed was aggressively going to raise rates and the economy was going to slow down, thus earnings were going to slow down. Like, there is zero justifiable reason why stocks are going higher. You could say from a fundamental perspective, yes, there's cash on the sidelines. Yes, the Fed is now in a cutting regime. There's these tactical things that are happening, but there's no fundamental reason why markets should be hitting new all-time highs into year end. And we did get a bit of a downside reset today with the S&P 500 falling almost 1%. I will point out the RSP was only down about 0.5%, which is actually a good sign for markets. Because I think we just got to face the music here. Nvidia is the market. Nvidia has accounted for over 22% of the S&P 500's gain over the past year. If Nvidia falls, the rest of big tech falls, and it takes the market with it. And that's the bottom line. And today we had very unfavorable news that the Biden administration may be putting some export controls on Nvidia, AMD, and Intel to dictate how many GPUs they can sell to what countries. And then we had news of ASML's disastrous quarter that just sent this thing home. Now, take a listen to this clip and let me know what you think down below in the comment section.
Yes, to talk markets, Alicia LaVine, head of investment strategy and equities at BNY Wealth. Good morning to you. We are in the middle of earnings season. Curious sort of what your big takeaway is thus far, and is there anything you're doing about it?
So far, clearly bank earnings are coming in better than expected, both top line and bottom line. Net interest income is better than expected. So that is a good signal for the economy. And I think the other thing that they're showing that our call for the no landing is actually playing out. And that's why you see the stock prices responding to that.
So there is no landing. Forget about soft landing. The plane is not even coming close to the ground.
It doesn't look like there's a landing right now. I mean, it's looking like a very close to 3% quarter for the third quarter, which is essentially 2 quarters in a row of 3%.
Right.
It's no landing. Right.
Pretty good.
And that's the goal, right? The goal was always to get it above 2%. Trend was 2%.
I've been told repeatedly that the economy is horrific. So this is surprising news.
So for part,
I say that somewhat sarcastically.
Well, I know you look for part of the population. It is horrific for those without financial assets. So consumer net worth is up $50 trillion in 4 years since the beginning of COVID, and essentially that's
say that again.
$50 trillion.
With a T.
With a T.
Yes.
With a T, which represents a 45% growth where we were before COVID. And that's financial assets, right?
So but that's only 44% of Americans?
That's what I'm saying. So if you own financial assets, whether it's housing or stocks, bonds, other financial assets, you're doing great. Right. You've increased your net worth, and your net interest costs are actually, as a percentage of your income, the same as they were despite the rate hiking cycle. Right. So the spread's higher. So you feel richer, and the percentage of what you're paying to service your debt is the same. Unlike the government, by the way.
Yes.
But if you don't own financial assets, it is not the same economy, and you're struggling.
S&P 500, where is it at Christmas, and where is it next Christmas?
So at Christmas, we see it at 5,900 into the end of the year.
Okay.
It definitely exceeded our estimates.
Well, we're sort of there.
We're there.
Right now. We're there. Does that mean that we should just go on vacation? At this point, should we just stop, sell everything, and take a holiday?
When the Fed cuts into a soft landing or no landing, which is what we think is happening, if you look back at 6 previous examples of this, on average, the S&P is up 16% in the 12 months, and believe it or not, 44% in the 24-month.
So you think that next Christmas we have even more to go?
Doesn't mean it's a straight line. It's never a straight line. The way inflation's not a straight line on the way down, the market's never a straight line on the way up. We just think that the conditions are such that if you look back in history, the Fed cuts into a soft landing, the market can do quite well.
Can I just ask one final question? The market, or the S&P as we described, is so concentrated today relative to maybe those examples in history. And so the question is, when you're investing, when you say the market, are we just investing in the market writ large, or what would you be doing?
So essentially, the S&P is more or less a tech index, right?
Yes.
We know that, right? And so the U.S. market is essentially a tech index.
Right, and that's different than what it may have been in these, when people look back in history and say, well, 6 times before it was something else.
Yes, but there was always concentration, and there are always large stocks that drove the market.
Okay.
The reason that these stocks continue to stay where they are is because the earnings and the margins are so much higher than any other company in the market. They're just driving the whole thing. So the margins of the S&P are higher. The cash flow is higher. If you go back over 20, 30 years, it's up and to the right in terms of cash flow margins and margins on the S&P. So you can get a higher multiple out of it, which is what we think, which is why we raised our price target into the end of the year.
I think stats are great. If the Fed cuts into a soft landing, then after the Fed cuts rates for the first time, markets tend to be up 44% 2 years later. But you gotta take it with context. I mean, these people go to college. They get some of the best jobs in the country. And they cannot figure out that the markets have long priced in a lot of that over the past 12 months, and that doesn't guarantee another 44% to the upside after the first Fed cut. And I know she was not saying you're going to get 44% necessarily as a guarantee, but the markets have rallied almost 35% in the past 12 months. I think you've priced all of it in. And the problem that I necessarily have is not whether or not we get a soft landing, but you've already priced in all of the soft landing, or pretty much all the soft landing, and you haven't priced in any risk of downside, of a slowing economy, of slowing earnings, any of that. You're finally starting to see earnings estimates come down for 2025, which is step 1 of that. And that could be one reason why markets fell today. Because we've all been gung-ho on this soft landing, on everything's fine and markets are going to go up forever. But yet we're actually seeing things deteriorate under the surface. And this was a bit of a slap in the face to a lot of Wall Street that was under that narrative. Now, tomorrow, as far as economic data, we're really not going to have anything. Export prices, import prices, month over month and year over year. None of that's going to be important. You do get the ECB interest rate decision on Thursday morning. You're expecting a rate cut from the ECB. You get retail sales out of the U.S., expecting that to come in higher than last month. Last month was 0.1%. You're expecting 0.3%. Initial jobless claims is going to be equally, if not more important than retail sales. Last week, you came in at 258,000. Some people said, hey, it was high because of the hurricane, and some of that was true. You did see a jump in Florida. You did see a jump in North Carolina, but you've seen a jump in Michigan. You've seen a jump in Ohio. You've seen a jump in Washington, right? California. You can't really just shoo that away. So for this upcoming week, you're expecting initial jobless claims anywhere between 280 or 258 and about 270,000. If you come in higher than 258,000, the number we had last week, markets are going to tank on that. You also get Philadelphia Fed Manufacturing Index, business conditions, CapEx, employment, new orders, prices paid. Unfortunately, the only thing that's really going to matter Thursday morning is initial jobless claims and retail sales. All of this other data will be important. Housing and business inventories, housing market index, retail inventories excluding autos. That will all feed into the GDP estimates, and you're going to get a big, potentially a big upward or downside revision for Q3 GDP. I think that can also be a big story on Thursday, given all of the data that we get. But it's really retail sales and initial jobless claims. Thursday and after hours, you get the inflation rate out of Japan, GDP growth rate year over year, industrial production year over year, retail sales year over year, GDP growth rate quarter over quarter, the unemployment rate, and industrial capacity utilization. That comes out 10 p.m. on Thursday, and that can also move some areas of our markets. Generally speaking, a better China is a better world. Now, I think specifically for Tesla, again, I think Tesla's going to follow what the markets do to a large extent. Unless you get good news for Tesla or bad news for Tesla, I think if markets sell off, Tesla's going to sell off. I think if markets rally, Tesla's going to rally. I think if we have a soft landing, Tesla's going to rally a lot more than the broader markets. I do think the risks are a lot more attractive in Tesla. The reward's a lot more attractive in Tesla. Both ways, Tesla's going to have a high beta. If we do go into some kind of recession, I think Tesla falls to the 140s, 150s, which honestly is only like $70 a downside here, which, yes, can be a lot. Of course, I don't want to minimize that. But the upside could be all-time highs next year. It could be $500-$600 next year. I think the upside in Tesla well outpaces the downside potential in Tesla. And that's why I like Tesla so much. It offers you a way to play really a soft landing that's not pricing in a soft landing. Like Wall Street, with this presumed narrative of a soft landing, should really have Tesla at like $380 to $420 per share. Like that's where I think Tesla should be right now. Just given the markets are pricing in a soft landing and Tesla is not. There's a disconnect there, and I like the odds of playing that disconnect. Now, Tesla's currently sitting at about $220 per share, $218 per share if you want to be more specific. You're above your 100-day moving average. That's great. 200-day moving average at about $202 per share. If you do get weakness this week, you're probably falling to about $200 per share. I think you're going to get a big move Thursday and Friday in markets. You also do get some earnings. Thursday, specifically, you're going to get TSM and you're going to get Netflix, right? So that's what I think will drive a bigger move for Friday in markets. I think Thursday itself, the trading day of Thursday, is really going to be about economic data. So depending on how things go in the markets, these geopolitical tensions as well, I do think there can be downside here in the next couple of weeks. But if we do see upside, I think Tesla's going to well outpace to the upside. And I do think buying Tesla at $220 per share, even if you have a 6-month, 12-month time horizon, makes a lot of sense right now. Especially if Tesla falls to 200, that's a great level to be buying. Better than 220. If Tesla falls to 180, that's really good. Now, if Tesla falls back to the 140s, 150s, that is, as I said before, a sell your kidney kind of moment. And the last time that happened, Tesla stock ripped to about $270 per share. It was up 100% from the lows you hit back in April, in which that was a big level. I was buying a lot of Tesla stock, and I would do so again. Mortgage the house at a 6% interest rate type deal if Tesla falls back to those levels. So I think you're going to get a lot of demand coming in here. and I think we'll really stabilize Tesla stock. I'm not expecting a 140, 150 retest. I think things would have to go really wrong in markets for that to happen. So I think downside somewhat limited. I think upside is massive, especially if we have a soft landing like markets are already pricing in. So with that said, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys stay safe out there, and I will see you in the next one.